So this is for Thursday's class on investments. So we basically introduced fixed income and bonds during Tuesday's class, and we started the first part bond pricing. So to summarize, basically you can see that the essence of pricing a bond is about calculating a present value. What you have is you would look at the bond's coupon payments and this par value, right? So you're looking at these cash flows. And then you discount these cash flows using appropriate discount factor. Now, what is the discount factor here? It's the bond's yield to maturity, right? So this R here refers to yield. And we could discuss a lot of things. And in this lecture on bond, we will discuss interest rate risk. We will discuss default risk. We will discuss bond duration. And all these concepts, they're related to this bond pricing formula. So it's really important to understand these basics, right? That is, the bond pricing formula is an important basic knowledge for you to remember. Okay, so now let's use a interesting example to do some practice and to understand this bond pricing formula. So this example is about after-tax bond returns. So what is the background story about this example? Well, we could actually use this picture here. So let's say you're a bond investor and you have bought a discount bond. Remember, what is a discount bond? When the coupon rate is actually lower compared with the yield, then this bond will become a discount bond. So in this case, you can see that this discount bond is given by this dashed line. Let's say on the initial date, you spent $48 to buy the bond. And after 10 years, the bond, the discount bond increases its price to $60. Because we know that as the discount bond approaches to maturity, its price will increase, right? So in this case, you can see that even if nothing happens, you will automatically get $12 price appreciation, right? So here you will get this $12 price appreciation. Now the question is, how the Canada Revenue Agency, right, the tax authority in Canada, will tax your $12 investment return? Well, in fact, they will actually consider this $12 as a interest income. So the $12 will be taxed at the interest tax rate. And then there could be other factors which could affect your investment return, right? For example, we have learned if interest rate decreases, then bond price will increase. This implies that if you're a bond investor, you will get some capital gains if bond price increases because interest rate decreases. And interestingly, in this case, the increase in your bond price will be taxed at capital gain rate. Okay, so now let's look at this example. So we basically have a 30-year zero coupon bond. And its initial yield was 10%. First question, what is the bond price in the beginning? Well, this is pretty easy, right? According to the bond pricing formula, P equals the discounted value of the par value. So let's assume this zero coupon bond has a par value of $1,000. and we have this yield which is at 10%, and we have 30 years. So this gives us 57.31. And now the second question is, what is the bond price after 1 year? And what is the appreciation in the bond price? So after 1 year, the formula should be almost the same, except now you're having 29 years left. And in this case, the discounted value would be 63.04. Right? And you can see that here the price appreciation is 5.73. And this built-in price appreciation will be taxed as interest income. Right? So will be taxed as interest income. Now, let's look at the third case. We assume after 1 year, the bond yield decreases to 9.9%. In this case, what is the appreciation in the bond price? Well, the formula again would almost be the same. The only difference is you will use a lower yield. So in this case, you will have 64.72. Right? And now what is the price appreciation? Well, it's 64.72 minus the initial price. So let me use my calculator to see what is the price here. 64 minus 5. So this is 7.41. And the question is how this appreciation will be taxed, right? Well, first you can see that this 7.4 can be decomposed into two parts. The first is 573, and the other part would be 7.41 minus 5.73, which is 1.68. So you can see that the appreciation of $7.41 can be decomposed into the built-in price increase and the increase due to bond yield decrease. Right? So this 5.3 is this built-in price appreciation. Right? What about this guy? This guy is the price increase of your bond because of the decrease in the yield. Now, obviously, the Canada Revenue Agency would consider these two components as different. So this 5.73 will be taxed as interest income. And this $1.68 will be taxed as capital gain. This is important because as an investor, you should care about your tax. And in reality, generally, generally, interest income has a higher tax rate compared with capital gain tax. Okay, now let's talk about bond yield. Obviously, if you're thinking about the bond pricing formula, you could see that bond yield is very important, right? Because it is the discount factor to discount coupon payments and par value. Now, what is the definition of yield to maturity? Well, yield is the interest rate which makes the present value of the bond's payments equal to its price. So here you can see that, let's say we have a 30-year bond with 8% coupon rate. Its current price is $1,276.76. And now what is its yield? Let's assume the par value is 1,000. Right? Let's assume this. Now you can see that we could use these four inputs to find out the yield to maturity. So we could use the bond price, par value, and number of periods per period payments. Right? So four inputs, we could get one output, which is the yield. Again, you have to be careful with these numbers, because here we are assuming this is a semi-annual coupon payment. So even the annual coupon payment is $80, then you can only use 40 as this per period payment, and accordingly you have to adjust 30 years into 60 periods, because again it's semi-annual. So accordingly, in the end, the R, you find out it is just the yield for 6 months, right? So in this case, you will find out R equals 3%. And you have to convert this half-year interest rate to this annual rate of 6%, right? So you can see that it's a very simple calculation. However, you have to be careful about the complexity because of the semi-annual coupon payments. And another thing is, you might wonder, hey, how can I calculate this half-year yield, right? Because obviously you cannot use a pen and a paper to solve this equation. Well, obviously you have a lot of tools, right? You could use your financial calculator. You could also use Excel. And you could also use some programming languages such as R or Python. I guess we could talk about how to use financial calculator to find out yield, right? That could be the interesting case, because I believe most of you, if you have taken corporate finance, you have a financial calculator. Okay, so I have downloaded a financial calculator simulator. So let's see how could we use the financial calculator to solve the half-year yield. As I mentioned, when you're solving the problem about bond, you generally have 4 inputs, and then you will use the 4 inputs to find out a single one output. This is true either in the case of solving for yield or in the case of solving for bond price. So if you look at this financial calculator, then this row, the third row, is about bond pricing. And what is this FV? It refers to future value. In this case, it is the par value, because par value is the money paid to you in the future, to be more specific on the maturity date. Right? PMT refers to payment, more specifically coupon payment. PV is the present value, which is the bond price. But a caveat here is, in both Excel and for a lot of financial calculators, present value is represented in negative numbers. Well, ideally, because you can see that when you're thinking about present value, it generally represents price you pay. So it's a cost, so it's a cash outflow. So that's why you would want to use a negative number. And then I divided by Y refers to interest per year. However, you cannot really take the Y as year. A more accurate statement is I divided by Y refers to interest rate per period. And what about N? Well, you can guess it. It refers to the number of periods, right? So now let's see how could we solve this 3% 6-month yield. Okay, let's first punch in these inputs. So first, future value. We have a future value of 1,000 because we have assumed the par value is 1,000, right? So 1,000 of future value. And what about the coupon payment? Well, it's $40. So $40. And what about the present value? Oh, that's what we want to solve, right? Present value is 1276.76. Remember, you have to use this minus sign here, right? So that's our present value. And number of periods, well, we have 60 periods, right? Now we have punched in all 4 inputs. Now it's time to find out what is the yield. So what you want to do is you would first press CPT. I guess it means compute. So compute yield. Now you have 3%, right? Perfect. Remember, this is 6-month yield. And you have to convert from 6 months to 1 year. So the annual yield is 6%. In your exam, I generally will not ask for 30 years. If you don't know how to use a financial calculator, then you will be fine in your final exam, because I will actually just ask for something like 3 years or 4 years. So in that case, it could be easy for you to use a pen and paper to solve your bond pricing problems. But anyway, it's a useful skill for you to understand how to use financial calculator, right? Okay. A related concept is yield to call. So basically, when we're talking about yield to maturity, it is based on the assumption that the bond will be held until maturity. But we know that there are different kinds of bonds, and a particular type of bond we have learned in the last class is called callable bond, right? So we have learned about this guy, right? What is a callable bond? It basically means the bond can be retired or purchased back before its maturity date. For example, let's say there is a callable bond and its maturity is 10 years. However, it can be called after 5 years. Then this means the issuer of this bond has this option to buy back these bonds after 5 years, or to retire them, right, after 5 years. So in this case, you can see that a potentially better measure is yield to call. So how do you calculate yield to call? Well, it's actually very simple. The yield to call is calculated just like yield to maturity, except you will have a different time and a different par value. To be more specific, you will use the time until call to replace the time until maturity. You will use the call price to replace the par value. Now let's use a simple example to clarify this definition. So let's say we have a 8% coupon rate, 30-year maturity bond, which is sold for $1,150, and it is callable in 10 years at a call price of $1,100. And now let's calculate its yield to maturity and its yield to call. I know this is a very simple problem. So first, let me draw out the timeline to give you some some clear idea the difference between yield to call and yield to maturity. So basically, this bond has a 30-year maturity, right? So this is the 30-year. And if this bond can be held until the 30-year maturity, then on the final date, you will get this par value, assuming there is no default. So the payment is 1,000. But now, this bond is actually callable in 10 years. And the call price is 1,100. It basically means that after 10 years, the issuer has the option to buy back these bonds at a price of 1,100. So you have the option to buy it back at $1,100. And now you can see that we basically have two differences in calculating yield, right? So basically, to calculate yield to call, you have to use this 10-year and this 1,100 as the final date payment. And to calculate yield to maturity, you have to use 30-year and you have to use 1,000 par value as the final date payment. Right. Again, I would encourage you to use your financial calculator and use these four inputs to actually calculate what is the yield to call and what is the yield to maturity. Okay, great. Now let's move on to the next section, which is about default risk. Okay, so we basically mentioned a very important type of risk in bond pricing, that is interest risk, right? To put it simply, it basically says if interest rate increases, as a bond holder, you will suffer because bond price will decrease. Of course, this is just one small part about interest rate risk. And then what is the second type of risk? It's the default risk. What is a default? Well, it's very easy to understand, right? It's just like if this firm borrows money from you, and when the time comes, this firm does not have money to pay back its debt. In this case, you could say this firm is in default, right? So very simple. Commercially, a firm's or even a country's default risk is measured by different rating agencies. In the US, you have Moody's and Standard & Poor's and Fitch. And in Canada, we have Moody's, Standard & Poor, and this, this peculiar firm, Dominion Bond Rating Service. So generally, a firm's default risk is categorized by different rating categories. The highest rating is AAA, and you will have increase in default risk as you move away from AAA. And to give you finer information, there is this modifier after a bond rating. Right? For example, if a firm is AAA, it could have AAA1, AAA2, AAA3, which means AAA1 is the best among AAA firms, and AAA3 is the worst among AAA firms. A very important concept related to investments in bond is investment bond versus junk bond. Right? What is the investment grade bond? Well, if a bond has a rating at BBB or above, then it is a investment grade bond. And below that threshold, below BBB, then it's a junk bond. Of course, junk bond is a bad name. if you like it, you could call it a high yield bond. But in reality, junk bond, high yield bond, they're the same thing. Okay, so you can see a example which gives you the different categories of ratings, right? You can see here that from AAA to D. And you could also see some sort of some sort of explanation about what each rating category means. Right? You can see that if you're looking at AAA, then it basically says that, oh, these debts have the highest rating and they have the capacity to pay back their interest and this principal value. And as I mentioned, these bonds, right? These bonds are investment grade bonds. And these bonds are junk bonds. This is actually quite important because generally when you're investing in bond mutual fund or bond ETFs, you will want to check its average rating. At least you want to know whether you're investing in an investment grade bonds ETF or you're investing in a junk bond ETF, right? I mean, normally, junk bond mutual fund will promise you a very high return. However, you have to know that you're also facing much higher default risk. And another caveat is sometimes you have to compare different mutual funds, right? For example, both mutual funds are holding investment grade bonds. However, you can check its average ratings. Maybe the first bond has the average rating of AA, and the second bond has the second mutual fund has an average rating of BBB. In this case, you would see that the first mutual fund with an average rating of AA to be a safer mutual fund, right? Okay, now let's look at several metrics which determine whether a bond is safe or how safe this bond is. Generally, when you're looking at a single bond, let's say you're looking at a single corporate bond issued by a certain firm, then you will want to look at this firm's financial statements, right? You will measure whether or how safe this firm is. Right? So here you can see that we're having several ratios used to determine the safety of bonds. The first is called coverage ratio. It basically measures to what extent the firm's costs are covered. So the first important one is called interest coverage ratio. I think we mentioned this, maybe not. But interest coverage ratio is the ratio of EBIT divided by interest expense. So it basically measures the firm's ability to use its EBIT to pay its interest. Now the second one is called fixed charge coverage ratio. So it measures how the firm's fixed charges are covered by its earnings. So it's the ratio of earnings to all fixed cash obligations, such as lease payment or sinking fund payments. I know we have not talked about sinking fund payments yet, but you will see this in the very near future. Okay, leverage ratio. Well, if you have taken corporate finance, then this is a very easy to understand ratio, right? So leverage ratio is basically the ratio of debt versus equity. Now, liquidity ratios. We talked about liquidity ratios when we were talking about financial statement analysis during the first lecture on equity analysis, right? So basically here you can see that we're talking about the current ratio or quick ratio. Now, profitability ratio. again, we have talked about this in the equity analysis chapter, right? So basically, it measures the firm's ability to generate returns by using its assets or using shareholders' equity. Now, the last ratio is the cash flow to debt ratio. So it's measured by total cash flow divided by outstanding debt. So obviously, you want to look at this firm's cash flow and you want to see that if the firm's cash flow can cover its debt. Right? Okay. So here we could take a look at these ratios by different rating categories. Obviously, this one is not required because some of these ratios we have not defined them, right? So if you just take a look at this table, you can see that there is massive difference between different rating categories, right? So the best or the most secure bond versus the bond with the highest risk, right? You can see that the number difference is huge. Right? Just pick any number. You can see that this debt versus debt plus equity. For this AAA firm, it's about 20%. And for this C-rated firm, it's almost 100%, right? Or you could look at these cash, or you could look at this EBITDA versus asset, right? You can see that this AAA firm has abundant cash flow, right? So its EBITDA is about 20%, and the C-rated firm has only 4%. Okay, now let's see what kind of or how could we reduce a firm's default risk, right? Because as an investor, you don't like default risk because if the firm is in default, you cannot get back your money. Right? So the first way to tackle this default risk is to use some contract, which is called bond indentures. So what is a bond indenture? It's really just a contract between the bond, the issuer of the bond and the buyer of the bond. So we could see several different restrictions which are used to protect bondholders. So the first is called sinking fund provision. So the first is called sinking fund provision. What is a sinking fund? The idea is basically like this. If a firm has debt, then the biggest risk is on this maturity date. Because you can imagine that on this maturity date, the firm has to pay back the principal. And principal is much larger compared with coupon payments. Now, how could we reduce a risk like this? Well, we could use a sinking fund provision. It basically means that firm will actually separate this payment burden of this par value over different years. Right? It's like if the par value is $1,000, now I will actually pay back this $10 in the first year, and then then in the second year I will use the sinking fund to pay back the additional $10. Right? I will continue to do so, and the benefit is on the maturity date I will just have a small portion of the par value left. Right? So it's much easier for me to pay back that smaller portion. Okay, the second one is called subordination of further debt. The idea is like this. If you're the lender, right? Let's say you have lent $100 million to a firm. In this case, you don't like the firm to take additional debt. Because if the firm takes additional debt, it will make existing debt riskier. It will hurt you as the original lender, right? So in this case, you could add this subordination provision in this contract. It basically says, hey, you cannot take on additional debt, right? You cannot borrow more. Or you could say you can buy more. Or you could say you can borrow more. However, my debt has to be senior. Here, senior debt basically means that in the event of bankruptcy, senior debt will first get its payment, and junior debt will only get payment after senior debt gets its payment. So you can see that if you can make your debt as a senior debt, then you will be safer, right? Now, there's also this dividend restriction. It's very easy to understand. It basically means that if the firm has default risk, then this contract would say that you cannot pay dividend, or it says the dividend payment cannot be above a certain value. This is actually very true. If you look at the recent regulation by central bankers, I think about 2 months ago, the Federal Reserve basically told a lot of US banks they could not increase their dividend. Well, because this is a sensitive environment because of the pandemic. So the last thing the central bank want is another banking crisis. So they would want to restrict the dividend payments from these banks. Okay, the fourth one is easy to understand. You could basically use some sort of collateral, right? If there is collateral, it means the debt is secured. It means that in the event of bankruptcy, as a debt holder, you can sell those collaterals and then you could get back your money. Right? This is this sort of universal, even in consumer sectors, right? Think about car loans, right? When you're buying a car, and if you're borrowing from the bank to buy a car, you will not get the title, right? The bank holds the title because your car serves as collateral, right? Okay. Now let's see how yield is affected by default risk. A very important caveat here is, what is a yield? Roughly speaking, it's a promised return, right? So if a yield is 8%, then the debt seller, the debt issuer, basically tells you that, hey, if you hold our bond until its maturity, if there is no default, then you will get 8% return, right? That's the gist of yield. But you can see that you will only get your 8% yield if the firm does not default. This basically implies that yield is the largest possible expected yield, expected return you can get from holding your bond, right? Okay, now let's see this example and to get a better understanding. So we suppose a firm has a 9% coupon bond 20 years ago. The bond has 10 years left, right? But the firm is having some difficulties, and investors believe the firm will be able to make good on the remaining interest payments. However, the firm will have difficulty on the final date, so the bondholders will only receive 70% of par value. The bond is selling at $750. Now, let's calculate the yield. Again, you can see that To calculate yield, you need 4 inputs, right? Always remember this. 4 inputs, 1 output, right? Coupon payments, number of periods, and per period payment, and final and your par value and the price of the bond, right? So basically, we could calculate expected yield and stated yield. So the difference here is you can see that it's about this final payment, right? It's about the final payment here. So if the firm is not or will not be in default, you will actually receive your par value of $1,000. So this will give you stated yield. However, if the firm will be in default, then you will only get $700. So in this case, you will use the $700 as the final payment. And then all other 3 inputs are the same, right? Here the coupon payment is 45. How do we know this? Well, we know 9% coupon rate. So the annual coupon payment is $90, which means the 6-month payment would be $45. And then it says the bond now has 10 years left. And because it's a semi-annual coupon payment, so we would use 20 periods. And this price, of course, it's simple. So it's 750. Again, you could use the financial calculator to punch in these 4 numbers, right, to get your yield. And you can see that in the first case, the expected yield is actually 11.6%. And for this stated yield, it is 13.7%. It basically says that if there is no default, you will get 13.7%. However, if there is default, then you should only expect 11.6%. Okay. Okay, now let's talk about default premium. So basically, the result here is sort of like we have learned about bond price and yield. We know that if yield increases, bond price decreases. It's the same as default risk. If default risk increases, to compensate this default risk, investors will ask for higher yield. As yield increases, this implies bond price decreases. So let me write this down. So basically we have learned yield increases, bond price decreases. And based on this, we would know that if default risk increases, then bond price will also decrease. So here the default premium, which is defined as the yield spread between the yield and the yield on a comparable T-bonds. Okay, let me explain. So first, we're thinking about default premium. And this premium is defined as a yield spread. So what is a yield spread? It's really a difference. Yield spread means yield difference. So how do you calculate the difference? You will use the bond yield minus the yield of a treasury bond. Okay, let's not use treasury bond. Let's say a Canada bond. Right? So it's a government issued bond. A Canada bond. And to be precise, you want to you want this Canada bond to have the same maturity as your bond, to have the same coupon rate as your bond. Okay? In this case, you can see that the yield difference will tell you the default premium because we assume Canada bond is default free. So there is no default risk to Canada bond. Then the difference between these two yields will just give you the idea of the default premium. Okay. So here we could actually see the yield spreads between corporate and 10-year treasury bonds. So here we are using the U.S. government bond, and to be more precise, we're using the 10-year treasury bonds. So what you can see that there is huge spike in default premium during financial crisis, right? This is very understandable. In the financial crisis, people basically consider that firms or their corporate bonds become much more riskier because of this financial crisis, right? So definitely people will ask for higher yield. And you can see that that's why yield will spike during the financial crisis, and the yield spread, the default premium will be much higher during that period. And you can see that the difference is actually quite large, right? If you look at this high yield, it's very sensitive to financial conditions. So at this point of time, just before financial crisis, the high yield spread is just about, it's actually very low. It's almost 3%. And during the financial crisis, the yield spread, that is the difference between the yield of high yield bond and the T bonds, increased to about 18%. You can imagine that during that time, if you were holding a lot of high yield bond, you would suffer a lot, right? Because the bond price of high yield bonds will reduce a lot. Okay, now let's see this example, this problem on default risk and default premium. Okay, this looks like a weird problem. Okay, let's see what this problem is about. Suppose that the condition of the firm in the previous example became worse, and investors now believe that the bond will pay off only 55% of face value. So previously we assumed the firm would pay back 70%. And because of higher risk, investors now demand an expected yield to maturity of 12%. Now, the first thing is we could calculate how the price of the bond will change, right? So you can see that it's a simple calculation. You can see the lecture note essentially gives you 4 inputs. Again, 20 periods, 6%, and a par value, sorry, not par value, the expected par value of 550. You're getting this number because investors expect only 55% of par value will be paid back. And per period payment is $45. So again, 4 inputs, right? Now we will get the bond price, which is $688. Oh, I think I have not calculated bond price on this financial calculator. So let's try to do this. Okay, finally. Okay, so again, 4 inputs, right? So we have 20 periods. And we have the per period interest rate of 6%. So 6%. and we have future value of 550. So 550. And we have the payment of $45. This is a per period coupon payment. So 45. And now we want to ask, what is the present value? That is, what is the bound price? So we would compute present value. You can see that this gives us minus 687.6, which is $688. Now, at this price, the stated yield to maturity based on promised cash flow is 15.2%. Now, how do you get this number? Well, here we are calculating the stated yield to maturity based on the promised cash flow. So here you will basically use different numbers, right? Because if you're calculating stated yield to maturity, then you will use n equals 20, I equals 6, a future value of 1,000. Now, if you use this, right? If you use this 1,000, then you could calculate the stated yield to maturity. Okay, let me make this better. So our purpose is we want to find out the stated yield. Again, we need 4 inputs. Right? Again, we have this 20 periods. And we have the payment of $45. And we have the future value of 1,000. Why we are using 1,000 as the future value? Well, it's because we're calculating the stated yield to maturity by assuming there is no default. And look, we want to look for the yield. So we have to find out, or we have to use the present value, which is 688, right? Again, by using your financial calculator, right? Inputting these 4 inputs, you should be able to get a cash flow of, I think it's 7 point something. Let's assume it's 7.6, right? And then this is just for 6 months. And so the annual yield, right? So the annual yield would be 15.2. You can try it on your financial calculator. I guess I am right. If I am wrong, well, just tell me. Okay. Now, remember we talked about how to reduce a firm's default risk. We could use bound indentures, right? It's a contract which sets a bunch of restrictions which make the bond safer. And a second way is to use CDS, credit default swap. It's actually an interesting financial instrument. So now, what is a CDS? It's actually just an insurance policy, right? So how this works? Let's say you're a bond holder. You wanted to insure against default risk because you think maybe your firm's bond could default at the year end. In this case, you could pay some money. You could pay some insurance premium to buy this CDS. Now, what is the benefit you can get? Well, it's an insurance. So clearly, if the default actually happens, you will get compensated. How do you get compensated? So basically, if you have the CDS and if the default happens, then the insurer will actually buy the bond and just pay back you the promised par value. Or it will actually pay the difference between the par value and the market value, right? For example, if you have a CDS and your bond defaults, and it only pays you $800, even if the par value is 1,000. In this case, the insurer who sells you CDS will either pay you $200 of difference, right, to compensate you, or the insurer will actually buy your bond and give you $1,000. So in the end, you can see that with the CDS, your bond is actually default free, right? Now, a second usage of CDS is about speculation. It's about earning money. So basically, if you expect there is a financial crisis coming, then if you buy CDS, because CDS is actually the insurance premium. So if the default risk increases by a lot, then this insurance premium will also increase by a lot. So you will earn a lot of money. Now, how the premium on CDS is determined, right? Well, you could think about this. Let's say there's an investor who holds a bond with the BB rating, right? So it's a bond with the BB rating. And now you can see that it's somewhat a lower rated bond. So you would expect there is some sort of default risk. So this investor would actually buy some CDS to insure against this default risk. And with this insurance, then this BB rated bond is almost default free. So you can say that CDS plus BB rated bond is equivalent to a AAA rated bond, right? Well, because AAA rated bond is almost default free, and CDS plus BB rated bond is also almost default free. So you could say that these two things are the same. That is, the left hand side equals the right hand side. Now, how do you determine the premium on the CDS? Well, you can see that if a CDS plus a BBB rated bond equals AAA rated bond, then this basically implies that the CDS premium will be used to compensate the yield difference. That is, the premium on CDS, this implies the premium on CDS, right, on CDS equals the yield of BB rated bond minus the yield of AAA rated bond. Again, you can see that we have learned that the yield spread will spike in a financial crisis. So that's why Bill Ackman's trade has earned 10,000% returns, right? Because market was in panic mode. So yield spread, I guess, increased a lot, right? So the CDS premium also increased a lot. And now empirically, you can see that this equation, that is premium on CDS equals yield spread. This statement roughly holds true from historical data. If you look at this picture here, right? So we're looking at basically two curves. The first curve is CDS. To be more precise, it's a CDS on 5-year government bond from Greece, right? Because I think 10 years ago, Greece was in trouble and their government bonds had high default risk. And then we are having this second line. which is the bound or the yield spread between Greece and German government bond, right? So what you can see here is the two lines, they roughly match with each other, right? So this implies CDS equals yield spread. Okay, now let's formally talk about interest rate risk. Remember when we were talking about bond pricing, we sort of talked about interest rate risk. Basically, we said, okay, if interest rate increases, bond price would decrease. This implies there is this interest rate risk. That is, increasing interest rate will make bondholders suffer, right? So we have introduced two sources of risks to bond investment. The first is default risk. The second is interest rate risk. Default risk is simple and easy to understand. And interest rate risk is actually much harder to understand. So it will occupy a larger portion of this chapter on bonds and fixed income. Okay, now let's start with this nice picture and see what kind of results we could draw from this picture. So basically you can see that we have four different bonds, right? Bond A, B, C. And the horizontal axis is about change in yield. And the vertical axis is about the percentage change in bond price. Clearly, what we want to see here is we want to compare these different bonds and see how they respond to changes in yield, right? So let's go through these observations and see if we can match these observations with this picture. The first result is bond prices and yields are inversely related. Well, this is easy to understand, right? It means that yield increases, bond price decreases. And here you can see that this is true. Basically, here yield increases and bond price decreases, right? And on this on this side, right, yield decreases and bond price increases, right? Perfect. Now the second observation, an increase in a bond yield results in a smaller price change than a decrease in yield of equal magnitude. So let's see how could we get this result from the picture. Now, if you look at this side, right? If you look at this side, you can see that interest rate increases by 5%. And what is bond D's price change? It's about minus, let's say, I guess it's about minus 49%, right? So we're looking at this guy here. Now, let's look at this side. So here, interest rate decreases by 5%, right? Because we're having this 0 to minus 5 difference. And we're looking at the bond D's price. Well, if yield decreases, then bond price increases. And bond D's price increases by 150%, right? So our focus is about these two numbers, this versus this. You can see that the yield changes by the same amount, but the price increase because of the decrease in the yield is much larger compared with the price decrease. because the increase in yield, right? So you can see that there is a symmetric response to yield changes in bond price. And this is actually a good news for investors. It basically means that if the interest rate increases by 1%, then compared with the case that the case that yield decreases by 1%, you will actually suffer less compared with the gain you could get from yield decrease, right? Okay, the third observation, price sensitivity is higher for longer term bonds. Okay, now let's compare A and B to get this result. So we're looking at A and B here. And you can see that for bond A and B, the only difference is their maturity, right? A has a 5-year maturity and B has a 30-year maturity. So now let's see the price response to interest rate changes between A and B, right? For A, you can see that it is here if interest rate increases. For B, it is here. Basically, it says that B has a larger change. Now, if you compare the case that interest rate decreases, now B is here and A is here. So again, B has a larger change. This basically tells you that the bond with higher maturity is more sensitive to interest rate changes. And we have learned about this, right? We have learned in the last class that bond with larger, longer maturity has higher interest risk. So this is exactly the third observation. Now let's look at the fourth observation. Price sensitivity is higher for bonds with lower coupon rate. So let's compare B and C. Right? Okay, now we compare B and C. The only difference between B and C is their coupon rate. B has a higher coupon rate and C has a lower coupon rate. And what you can see here is C is below B if interest rate increases, and C is above B if interest rate decreases. So this basically means C is more sensitive to interest rate change. So the lesson here is a bond with lower coupon rate is more sensitive to interest rate change, right? So I guess we have talked about this in last class, and the intuition is actually fairly simple, right? You can think about this. Bond B has a 12% coupon. It basically means you will have larger portion of your payment from coupon payments. Right? It means that a smaller portion of your returns are tied to this par value, which implies that you will be less affected by the interest rate change. So that's why a bond with lower coupon rate has a higher interest rate risk. Okay, let's talk about the fifth observation. Price sensitivity is higher for bonds with lower initial yield. So let's compare C and D to see this result. So for these two guys, you can see that C has a higher initial yield and D has a lower initial yield. And if you compare C and D, you can see that D has a larger price response. It's the same in the case of decrease in yield. Right? So again, D has a larger response. So the lesson here is basically a bond with lower initial yield is more sensitive to interest rate changes. Right? Okay, now let's see the last lesson here. As maturity increases, price sensitivity increases at a decreasing rate. Now let's see how this works. So we compare A and B. Right? We compare A and B. And you can see that if you compare A and B, right? You can see that A has a maturity of 5 years. B has a maturity of 30 years. So B has 6 times the maturity compared with A. Right? So B 6 times A's maturity. Now let's say the interest rate increases from 0 to 5. Right? Now you can see that bond A's price, we don't have an exact number here, but I think A's price decreased by, what number should I choose here? Maybe 20, right? So decreased by 20%. And for B, it decreased by, I guess it's minus 40%. So you can see that the change in B's price, right? So B's price change is about 2 times A's price change, right? So let me remove this redundant line here. What we want to look at here is these two numbers. So basically it says that the change in bond price is smaller compared with the difference in, let me restate this. So it basically means that the difference, right? The difference in bond price change due to interest rate change is smaller compared with the difference in the maturities, right? B has 6 times of A's maturity, but its price change is only 2 times A's price change. So that's why you get the last statement. As maturity increases, price sensitivity increases at a decreasing rate, right? That is, price increases slower compared with maturity.